Hi everyone. Thanks, Kevin. As Kevin said, I'm George Macheras. I'm a partner here in London at Watson Farley, and I head up the Maritime team globally at Watson Farley. I have the pleasure to introduce Christo Nikolov, who is the Senior Vice President at the Ocean Industries Group at DNB. Paul Taylor, Global Head of Maritime Industries at SocGen. Abhishek Pandey, Global Head of Ship Finance at Standard Chartered. Vassilios Maroulis, Global Head of Shipping at Citi. And Steve Fewster, Global Head of Ship Finance at ING. And today we're going to talk about the Poseidon principles, the basic principle of which shouldn't really be that complex, nor is it unique to this industry. Really, the basic premise is that banks should be encouraged to finance greener assets, or at least to take into consideration sustainability when they decide who they're going to finance and what kind of transactions they're going to enter into. So the theory is not very complicated, and actually the practice, in theory, shouldn't be that complicated either. The most straightforward way for banks to comply with Poseidon principles, one would argue, is to finance newer and techier assets. So I want to start this discussion by perhaps pointing out an obvious but perhaps inconvenient fact for 2023 anyway, which is that the new building order book is looking quite low. New building orders across all three segments, container ships, tankers, and bulk carriers, is not high this year. So for banks, where do the opportunities lie for this year and for the coming months vis-a-vis the Poseidon principles? Perhaps Steve, we can start with you.
Yeah, sure. Is my mic working? Good. Yeah, thank you. I'm not sure I quite agree with you, George.
That's why I wanted to start the conversation with you.
That if you go to the top tier yards, top Korean yards, top Chinese yards, I think they are still quite full, but typically it's container ship and LNG vessels. But for the more conventional bulkers, tankers, then yes, I think you're right, the order book is low. And on the one hand, that's very good because it helps us to manage the supply side. And what we typically know is that the supply side is the equation or part of the equation which kills the market. So, in that respect, I am quite positive, but reflecting the lack of orders in those segments, I think for the banks this year, it's going to be a relatively quiet year. I don't expect we will have the same volume of transactions that we've seen in the past few years. Now, I think actually that's not such a bad thing because we don't want more ships ordered running on conventional fuel. What we need is new ships, latest design propulsion systems. And those aren't really here and readily available yet, and certainly the landside infrastructure isn't there yet. So the fact we're not seeing a lot of orders is good. And what I would want my team to do in the various locations that we are, is to actually spend that time that they've freed up, not doing new deals, talking to the owners and really getting an understanding and really putting some pressure on them to decarbonize their existing ships. And that's maybe where we can help. We can finance some of the changes to existing vessels which will improve performance. And then just very quickly, because I'm conscious others will have things to say as well, I think the other thing that I'd like to see the banks doing is how can we extend the life of the existing ships? Building a new ship has a horrible carbon footprint. And yes, it might well save fuel, but typically those fuel savings, it takes 7 years to offset the carbon footprint of a new building. So if we can find ways to work with owners and engage in a dialogue with them to improve the existing ships, I think that's where one of the opportunities will be for this year.
Thank you.
Paul? I'd just like to say I completely agree with Stephen that it's not such a bad thing that this year may be quiet on the new build front. I mean, so there's still a healthy pipeline of deals to be done, but we've got to look at the other things we can do with our clients, and entering into not just the communication on retrofits, upgrades of the existing fleet, but strategic dialogue with our clients. You know, there's many other avenues, pathways to business than just financing vessels. And I know the question was about Poseidon principles, but you know, to be smart in this industry, it's not a question of lending as much as possible. You know, sometimes you have to accept that it is going to be a quieter year, and embrace that and use the time wisely.
I mean, it's very clear the world does not need more ships running on fossil fuels. It's that simple.
Abhishek?
Yeah, so I mean, it's a perspective, right? So 10% of the fleet is the order book as of December last year, which is December 2022. We had that equates to about 4,500 ships on order as compared to 5,000 a year earlier. So yes, depletion in the number of ships that has been ordered and the activity. That not necessarily translates to lesser business on the new building side, because the fleet, which was valued at $250 billion a month ago, was actually about a year and 1 month ago was valued at $207 billion. So if you're a banker and you can fund on a risk-adjusted basis, i.e. the leverage risk-adjusted basis, there is enough and more pie for you to do the financing on the new build side. Now, when I say risk-adjusted, it is not just LTV, which is loan upon value, and then you see values are inflated, you kind of readjust your leverage on it. It's also more about being cognizant of which sectors do you want to go to, right? LPG is at 20%, LNG perhaps around 50%, which makes gas as a heated segment on the new build side. So if you can calibrate your risk, I think as a banker to support the theory that you just said, on the new building and Poseidon principles, there is enough business, at least the same, to do is what I would like to say. So I didn't really see activity in terms of dollar terms, I deplete. It was more on the prepayment side and number of ships that were financed.
Christo, thank you.
Yeah, thank you. And we definitely see increased competition because more banks want to do new builds, and there is overall maybe a limited new ordering in some of the more commoditized sectors. But we should also think of the energy transition as an opportunity, not just a challenge when it comes to new financing. And we, within DNB, have created a separate team within Ocean Industries called Energy Transition Team, which focuses on analyzing new technologies and new sectors, and ultimately helping us to provide support to these sectors. And we've been very active in arranging capital, for example, for the offshore wind industry. We are big believers in the potential of carbon capture, and we've been supporting some of the early projects there. We've been looking at some ammonia projects, et cetera. So it does also open up opportunities when there's more competition and we see kind of pricing compression on new build financing, to look at other things.
Thanks. I mean, the recurring theme here is, and what I keep hearing from all of you is the F word, which is fuel, and fossil fuel, perhaps double F word. Do you then think that, fair enough, the world does not need more conventional fuel burning ships. Eventually the world will need new ships with alternative fuels. Do you expect, therefore, the new building activity to pick up, green financing on that new building activity to pick up again once there's greater clarity on the alternative fuel? I mean, I know, Vassili, you have views on that, and at least my experience on that is that you ask 5 different people in shipping what's the next alternative fuel of the future, and you'll get 5 different answers.
Yeah. The simple answer is that everything will be required. But what I think is extremely positive is that all of our clients, the ones that we speak to on a regular basis, are ready they're there to embrace what is happening. They want to be able to proceed. They understand where we stand, and again, I have to go back slightly to the subject matter, which is Poseidon Principles, which is, I believe, very strongly, effectively, the license in order for the banks to continue to operate in this space. We are what we measure. We have to be very firm with the requirements that we have, and those that want to go on the journey with us, we will be there with them, support them 100%, and those that cannot follow, then, you know, ultimately capital from, I guess, those that will be part of the Poseidon Principles will have to reduce in time. In terms of the various propulsion systems, I think a lot of progress is being made in terms of whether it's methanol, ammonia, whether it is, you know, even nuclear potentially, you know, at some point in time, but also retrofits and increasingly carbon capture. All of these things will be required, but at the end of the day, the ship owners can only do so much, you know. Let's assume that the propulsion system on a methanol vessel was absolutely 100% there tomorrow. A lot of owners would make that order, and it would be financed potentially quite easily, whether it is from the banks, all of them competing, compressing margins, or whether there's capital markets or whatever it is that you want to go for, or ECA. Fact of the matter is that the fuel isn't there, readily available, to be able to bunker the vessels and potentially the global fleet. So ultimately, I do sincerely believe, and I think the Poseidon Principles and the Sea Cargo Charter and multiple other, let's call it wider alliances to a certain extent, we need to be advertising more and saying more to the wider community that ultimately this industry is ready for change. It is shifting, but ultimately we also need the assistance of those that actually will manufacture bunker fuel and everything else for those for the fuel to be available. Otherwise, yeah, it's just pointless.
Just to play devil's advocate, I have no doubt that, as you say, once we get there on the fuel, owners will be very happy to comply with it. It's not, to my mind, it's not a question of desire or willingness to comply. Certainly, banks will be able to finance that in a more straightforward manner. But as you also point out, Vasily, we're in a transition. We're not there yet. We're in a transitional stage. The world still needs to move during the transitional period. So from the bank's perspective, and I think what Christo also said earlier about the technology is quite interesting because there's a technology risk on that for now. So how do banks actually factor that technology risk into their own risk assessment, not just in general terms, but also within a set contractual framework such as that of the Poseidon Principles? Paul, I don't know if you want to take that, and then Vasily, you can follow on afterwards if you want.
Yeah, sure. I mean, first of all, yeah, we're all facing unprecedented technological risk, that's for sure, and whether it's in fact new technology or old technology. And the new technology, clearly we're all waiting for the fuel supply to be scaled up and ready, and that's going to take quite a while. We've also got new trades in terms of CO2 shipping, carbon capture, ammonia cargo, methanol cargo, wind farm installation, etc. So there's plenty of technology risk that we've all got to consider. But let's be honest. This is a gradual transition. It's an evolution. It's not all happening overnight. And we're going to be sitting here in a decade's time, still waiting for a lot of that fuel supply to be deliverable and scalable. So technology risk, yes, it exists, but it's also something which we must put into perspective. And I don't believe that the current fleet is at risk of being a stranded asset. So, so what can we do as Poseidon Principles banks? Of course, we want to finance the newest technology available, and I think there's great competition for that type of business. But we also want to finance existing assets, and I think that's sometimes misunderstood in the market. Everyone thinks that that market is dying. It's not. So, how can we go about managing technological risk? I think there's various ways. Firstly, in our quest to be net zero, which is what the Poseidon principal banks have committed to last September, we need to get the trajectory to zero right and not over-promise on what's deliverable before the market's ready, because the banks are not going to do it single-handedly, quite clearly. It's the market. Secondly, I think the market today, the financing market, is not an asset driven. It's not asset finance as such as it was in the 1990s. The old crazy KG model's gone, thank goodness, and we've now got a corporate approach. And I think most of the Poseidon principal banks have a corporate approach. And what does that mean? It means we're looking at the ship owner first and foremost, and we'll have recourse to the ship owner, and we will bank these new transactions. Yes, a long-term charter would be very nice, but if a methanol-ready ship was ordered today, I'm sure we would finance it for most high-quality ship owners with or without a charter. And one other way I think technology risk can be mitigated is by looking at an ESG rating for all ship owners. So that's what we're doing at SocGen. We will rate every client based on several pillars, including commitment to net zero, action to date, sustainability reporting, and their carbon footprint. And it's these clients, it's not just to support the clients and do the right thing, and this is risk management. It's actually supporting those clients that actually are taking the energy transition seriously and who are also managing technology risk themselves.
Yeah, I'll echo what Paul said, and it's extremely important to us, and I know I'm saying it in each and every panel, but especially, I think each and every bank here is the same thing, but we are, and a lot of the banks are shifting, corporate financiers. There are, of course, the alternative lenders and multiple other institutions that will be looking just at the asset, LTV and all of that, but in terms of the banks that are there, alive and kicking and providing significant capital to the industry, it is shifting in that way. And therefore, you're looking at the corporate as a whole, right? And that's extremely important. And then over and above that, you have an element of consideration, exactly as Stephen said, which is, at some point one needs to look at the environmental impact of building also a new building versus, transitioning a second-hand vessel. And therefore, as a result, I don't believe that you will have stranded assets in a significant way. Yes, you may have situations here and there, but also very importantly, it is a relationship banking approach that one is taking. So therefore, there's very regular dialogue with all of our clients. We don't meet them once a year, say hello, what's going on. It's a continuous dialogue, you know what's going on, and there are significant efforts that they are, and time and money that these companies are investing in trying to figure out. They know that this is an extremely important time for their future, potentially either something that could open up unbelievable opportunity or potentially lethal. Of course, what's the time horizon? Debatable. So you're seeing all these things, and we analyze all of these elements in order for us to take a view and then see, are we going to finance effectively retrofitting, getting things improving slightly, because ultimately that's what we want to do. It's not only a methanol-ready ship, which of course there is no green methanol, so therefore, okay, what is it going to burn anyway, versus actually improvement of the carbon footprint of an existing fleet.
If I may, completely agreed, but there's a different approach as well for technology risk. If you plot the technology risk over a period of time and look forward, it diminishes or it fails, right? Now today, you've got about 105,000 vessels in the world, and about 1,300, give or take, is dual fuel already, which is, so to say, new tech. and that's 1% or 5 million by deadweight tons, right? 5% by million deadweight tons. You look forward of your order book, more than 50% almost is dual fuel already. So if you plot it against the axis of time, I mean, you have a deep resale market to that extent developing into the new technology, which in my view diminishes the technology risk over a period of time. It still is a laggard to the existing asset, but gives you almost 10 to 15% of dual fuel ships in the world at any given point in time, which is almost a 10% increase by the time the delivery happens. So technology risk, the way we look at it, it diminishes over time. It's important to, so we have a transition finance framework like most of the other banks have talked about. I won't go into that, but what we are trying to say over here is that, yes, technology risk is there, it is accepted. Broadly speaking, fuel is a question mark. Technology, dual fuel, the question is which is the second fuel. But can these ships trade on a premium? Can they be, not exactly technology, but you take a A380 example. If you had a A380 as a lessor at that point in time, you can either sell it to Singapore Airlines or Emirates if a default happens. I think that this industry being fragmented, eliminates the liquidity risk of that. My main challenge, the way I look at it, is that sometimes I feel it is underrated. Is the bank capital's attraction to take this technology risk, which will be challenged through the banking regulations which are coming, i.e. Basel 3.1, right? I mean, you have to look at 20 years of data to allocate a for sale value if I am on an advanced internal rating-based approach. There is no 20 years of data you're going to get here. So what do you default it to? Which means the capital allocations by default going into new technology, which should actually be incentivized, may be challenged. So in a nutshell, we feel that technology risk is still takeable, diminishes over a period of time, need to be addressed. If the bank capital needs to be serious, also need to be addressed on a commercial viability perspective to incentivize this rather than kind of bring it back, regress it.
Can I just say, I mean, I agree with a point that Paul made earlier, and I think, Vassilios, you sort of reinforced it. We're not lending only to the asset. Primarily we're lending to the balance sheet. And, one of the things that we will look at is the owner sufficiently financially robust to be able to absorb that technology risk? What banks do is we take credit risk. And I think going forward, what we may have to see is that these risks which are sort of emerging in the market will have to be carved up and allocated to those parties who are best able to assess them and therefore manage them. So, going forward, I would like to see a situation where the engine manufacturers and the shipyards are providing the performance guarantees, i.e. they warrant that the engine, the ship, will do what it says on the can, that the ship owner takes the operating risk, we take the credit risk, and hopefully a long-term charterer will take the market risk. But if you start trying to pile risks onto organisations which are not well placed to assess and manage those, we're never going to make any progress. Just one other point I'd like to just quickly make about the life of ships. We talk so much about fossil fuels, but we're still building ships with an expected 20, maybe 25-year lifespan. And we have to, I think, look at the way we design and build ships and see if there's not a better way. Why can we not build ships which are more modular in design, so it becomes much easier to swap in, swap out replacement parts, that you can update the parts as technology progresses? But as an industry, we're not good at doing that, and we're not really talking about that either.
That's a good point, Stephen. I'd like to address that, but just I think, having heard you talk about technology risk, I think the two immediate takeaways that at least spring to my mind is the first one is that technology risk is not about designating risk on a sole base. I think as Vassilios put it, which, if I may say so myself, I 100% endorse, is there's only so much you can ask your ship owners to do. This has to be a collective exercise. And secondly, technology risk is more than who pays for it. It's a wider credit risk that banks, owners, shipyards, other stakeholders have to take into account. And On the subject of existing ships, and just scaling away a little bit from new buildings, do we therefore see that for now there's opportunities with second-hand ships, whatever Poseidon principle-related challenges this may bring? Maybe Christo would like to take this.
Yeah, and banks are under pressure today to green their books and their portfolios. So it may be very tempting to just go for the, supporting the shiny new build. But I think Steve made two very good points there previously, which was we probably need to have a more holistic approach and look at call it a wake or a well to wake view, or maybe even a well to scrap view. And really assess the merit of building and the carbon footprint of building a brand new vessel versus continuing to run your existing ship, and also the ESG footprint of recycling what could be up to 85% of the fleet that will not be able to run on alternative fuels today. Is that something which is optimal or even feasible? So those are the things that we need to think about, and when we take that into consideration, we as an organization see a lot of merit in continuing to finance second-hand ships. We've been very impressed by some of the work done by our clients on optimizing technological improvements on the hull, digitalization, data gathering and collection, which has resulted in some pretty meaningful reduction in carbon emissions, which is also makes sense from a commercial perspective. If you reduce your emissions by 30%, then you also reduce your fuel cost by 30%. So it's good business. So we see a lot of value in that, and to paraphrase a colleague of mine, we see that energy transition not as it's not a sprint, it's not even a marathon, but it's more of a triathlon, right? We see different phases. We're in the first phase now, where probably the best value we can extract is from improvements to the existing fleet, and eventually there will be step changes, there will be technological changes that we're also there to support.
Paul?
The financing second-hand vessels is going to continue for sure, but as the trajectory for the Poseidon principles intensifies and becomes more ambitious and goes towards net zero, we've got to also try to align ourselves, the banks have, over time. Not necessarily immediately, but of course this is our commitment. Therefore, there has to be an ambition or a target to achieve it. So, and financing second-hand vessels will become more challenging. I don't mean that across the board. Of course, we're all going to carry on financing second-hand vessels because we have to bank the client. And hence the reason why we need to bank the right clients. But at the same time, whilst we mustn't be prescriptive, we also need the ship owners' help in upgrading and retrofitting the vessels. Because as time moves forwards, it'll become more and more difficult to align the portfolios. You finance a vessel that's 0% aligned today. If nothing happens in terms of slow steaming, retrofitting, upgrades, etc., by 2030 it will be 80% misaligned. So, and then there will be no market. So, retrofitting and upgrades has to take place, and that's going back to a point that Stephen made earlier on about communication with our clients. That's absolutely key.
If you see the opportunity, the way we engage the clients mostly, second-hand ships, obviously, client-driven, so you will tend to client needs. But it's important to work with the client and take them with us on the transition journey. So if you look at the Global Energy Perspective, which was published in alliance with Maersk Mc-Kinney Møller, zero carbon shipping, it estimates that between now till 2030, the retrofit market investment needed is about $34 billion to follow the IMO trajectory. And from 2030 to 2050, it is tenfolds of that. It's almost $350 billion. So there is a huge market, huge investment need that needs to be capitalized on. I think it's the engagement with the clients. So second-hand ships will be financed, but the second-hand ships will be financed with a criteria, and that criteria is the broad-based spectrum of retrofits, which you can get yourself comfortable with. That is ESTs, engine upgrades, shaft limiters, etc. So there is an opportunity, but there is also an education that needs to go in.
Thank you. I think we've got time for one more question. Being a lawyer, I try to paint a picture of doom and gloom. It's in my DNA, unfortunately, or you have done a very good job at beating me to that. So I'll take one more chance at that. We're coming up to the 4th year since the Poseidon Principles were published. It's been longer than that since Watson Farley was locked into a room by very senior bankers, some of whom are on this panel, and was asked to prepare the first draft of the Poseidon Principles. So how have we done? How are we going to do? It's probably either the most difficult or the easiest question for today. So, Abhishek, on the basis that you're the furthest away from me, I'll start with you.
I would say how we've done. Probably, there are people who are more experienced than me. There's Michael, I can see, who's sitting here, who's been at the helm. There is Paul. There's Steve. There's DNB Bank. So I won't be able to comment. I mean, these are the formative guys who've seen it through and essentially made us reach here. But what I strongly believe, and we joined about 2 years ago, is that, for most of the things, if you can't measure it, you can't manage it. And what Poseidon has very simply done through its 4 pillars of assessment, accountability, transparency, is basically made us comfortable that we can measure something. Management is dynamic. I mean, we are adjusting trajectories. We are going from 2 degree to 1.5 degree. And it's a collective effort. It's not the effort, or it's not the responsibility of only those 4 or 5 banks who came along and did it. I mean, look at the way it has gone to insurance. So I think, if you ask me, it has been phenomenally successful in leading the way. It has convinced us. We took 2 years to join in, but probably, it is one of the good decisions that we took. We know how our portfolio looks like. We know how it's going to look like numerically. So which helps. And the other point is basically, there is a strong support for it coming. If 70% of the ship financing book, I mean, the banks are already signatories, and I am extremely glad that when we came in, probably we were one of the banks who did most of the business in Asia, and now there are a number of banks. Plus, there are actively banks approaching us, me and my team and my colleagues, to educate them on actually what Poseidon Principle does. So I would say that it has been a success, and I think it has started a very good reinforcement. But I would leave it to Steve and Paul, who started it, to comment probably on the performance.
Look, we're on a journey, and it's still very much the beginning of what is going to be quite a long journey. But I think what I don't want to say pleased about, but I think what I've realised is that within the organisation and within the shipping team, we now have a much better understanding of our portfolio and its carbon footprint. And we've still got a lot of work to do on that. We've got a team of data scientists and a ship manager down in Singapore who are building, computer simulations. So I have much more real-time data, if you like, on what does our portfolio look like. Because currently, the latest data I have on my portfolio is as at December 21. And I haven't had to date much of an idea what it has looked like since, how it's evolved as transactions get repaid and new deals get done. So there's this much greater awareness in the bank that we have to manage the portfolio in line with the Poseidon Principles guidelines. And so far we've been able to do that. But what we're realizing is that actually even just financing 1 or 2, should we say, bad ships can actually move your score quite significantly. Now the advantage of recognizing, if you like, those bad ships is you can then go and have the discussion with the ship owner and say, look, we've run it, we've run the simulations. This ship does not look very attractive. What are you going to do? What are the plans to retrofit, etc.? And if they say, Stephen, do you know what? We're really not interested. We're just going to run the ship into the ground and make as much money as we can. Then that means they're not a client for ING, and I'm sure for none of the other Poseidon Principles banks. But we now have the data to take those informed decisions. If they say, yes, we know it's not performing well, but we're going to do a number of things, we're going to change the coatings, etc., etc., and we can see that they are recognizing their social obligations, then we're happy to have them as a client, and we continue this journey together. But it's the awareness within the organisation, and actually it's the dialogue that we have with our clients and other stakeholders that has also raised the awareness of the importance of what we're doing.
If I could just say one thing, we've got to finish, but when Michael, with the help of Christian Holt and myself, presented the Poseidon Principles almost 4 years ago, we were sort of criticised by some as entering into something which was hugely ambitious and unrealistic. And here we are today being told we're not ambitious enough. So that shows you how far it has come. One of the things I think all the banks are now doing is bringing climate alignment into all credit applications. That's a huge step forwards. And whilst it's not perfect, we're now looking at the next step, which is zero carbon emissions through to net zero 2050. And that step is a difficult one because we need to get that trajectory right. But I think it's going very well.
Okay, well, personally, I'd like to thank each one of you for a very challenging discussion, a very thought-provoking discussion, and on behalf of myself and the panel, I'd like to thank the audience for listening in. Thank you.
Thank you very much. Okay, George and panel, thank you very much for that. We're breaking for lunch. Lunch is in two places. Through that door just there, there's seating for about half of you. And then on the balcony behind, there's standing lunch for the rest. So you can choose where you go to. Thank you very much, and we'll see you again in about 1 hour, please.